Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
These numbers came from the European Central Bank just this week, I believe. And it said the Eurozone financial institutions that are tied to the euro are sitting on 984 billion of long-term debt refinancing needs by 2012. I think I don't think like 700 billion, or I forget what the number was that's coming due in 2011. But that's a lot of money, and we think even the number coming from the ECB is very, very conservative. We think there's even more of a problem. The question is as everybody's scrambling for funds in the Eurozone, how are these banks that are sitting on all this bad debt expecting to get funds back into their balance sheet when the credit risks continue to rise and rise and rise? That's a very, very big question. And it doesn't even include all the exposure the Swedish banks have, the Swiss banks have, and the UK banks have, and they have a big exposure. Sweden and Switzerland especially, to Eastern European and Central Europe, big time Sweden, and the reason Swedish banks are very, very risky in here is precisely because of this idea of contagion. If the European banks, and we've already seen this before, and it's a commonality for banks that lend to risky places or emerging markets in general, it's the idea of the center versus the periphery. The center is the core of prevents the core of the financing and sends money out to the periphery, out to the Europe. In the periphery, in this case, if we think of Europe as the whole zone, the periphery is Central Europe and Eastern Europe. The core quality banks, if there are any left, or at least at the time, that provide the funding are the ones that provide credit lines to this periphery out there, the Baltics and Hungary and Czech Republic, those types of things, Ukraine, different places. So if the core gets in trouble, which it is, these banks have to save themselves. That's the first thing they do. And the first thing that happens, the periphery loans all of a sudden just are taken right off the table. So the Eastern and Central European countries on what's called contagion all of a sudden lose their financing first. That leads to sovereign defaults in those countries. And that's why you tend to see the emerging markets so susceptible to default. They lose their credit lines because they have no central source of financing to a degree. And this is where the contagion comes in. If we see the core of Europe get in trouble, which it is, I mean, again, in another big panic, Eastern and Central European countries feel the pain directly and actually more quickly as their credit lines dry up. And that exposes, Sweden and the Swiss banks, we think, in a pretty big way, besides the ones that are tied to the euro. So it's not just those banks that are tied to the euro that could be in trouble. We think it's the entire European banking system that has a whole bunch of exposure here. So the summary rationales here, I guess we could say, sovereign default, and we still don't think they're priced in here. German incentives that remain in Europe are just fading very, very fast. And if the euro muddles through, and we'll get to this, we think the euro grinds lower in valuation. And these are really two scenarios. We can't see a scenario in here in which good things happen in the Eurozone during this crisis. We can see this as the best of the outcomes, that they muddle through in this crisis, that some way, somehow, austerity measures kick into gear, and somehow some efficiency comes into the system. Germany continues to backstop everybody, and they get through this period. That we think is the best outcome. And of course, the worst outcome is breakup. And the chance of breakup, we think, continues to rise by the day, actually. And we think it's only going to take one country, obviously like Spain, to step up and say, we're better off outside of the euro, devaluing our currency, and doing our own thing. And I think pretty much game is over there. We'll see others do it. We've already read some background stuff of talk in Netherlands Obviously they're not in trouble, but they're part of the European Monetary Union. Them talking about getting out of this. The other advantage of this breaking up is that we'll be able to trade all these currencies again. I was kind of upset when the euro came because I used to trade the guilder and the D-mark and the French franc, Spanish pesetas, Portuguese escudos on occasion when I really wanted to lose money. But if all these currencies come back, it just gives us more and more action in the currency market. So maybe that's another secret reason why we're hoping for breakup. But the possible implications of this is really scenario number one of a muddling through, that there's maybe a minor impact on the global growth, and we still hear a lot of people saying that, and we're still seeing in the very, very strong numbers coming through in China. U.S. manufacturing, U.S. exports are still pretty brisk, and part of the reason is the majority of exports don't go to the Eurozone anymore. U.S. exports, Canada, Latin America, Asia take the bulk. So this hit in Europe hasn't hurt the U.S. as it would have in the past, where more and more of the U.S. exports went there. But the reality is we haven't seen the effect of austerity into the numbers yet. But let's assume that we do see them muddle through, and for some reason they can get through here. From a currency standpoint, one of the currencies we'd like in this scenario, a non-crisis scenario, but something in which the euro looks like it's going to continue to spiral down on lower and lower growth. We can see the British pound actually surprising on some type of kind of a haven flow. A lot of portfolio money in Europe that doesn't want to go to the dollar for various reasons is going to go to the pound, we think, because the pound is outside the monetary union. The pound has devalued in a very, very big way against the U.S. dollar. Pound right now, 146 was 211 before the credit crunch started. So we've seen a major devaluation there that has helped relieve the pressure inside the UK economy. Again, not to say we don't have massive amount of problems in the UK economy, just as the US does, but the UK has generally it controls its own destiny with its own monetary and fiscal policy, and the ability for the currency to fluctuate and provide that pressure valve. So we could see near term the pound doing well in here, especially if things look hunky-dory for a little bit and commodity currencies continuing to run on the background of global growth. Ultimately, if we see, again, positive news coming into Europe, we think the dollar makes a correction near term, maybe multi-day, maybe multi-week type of correction, but ultimately we think the dollar will rally long term, again, on relative growth compared to Japan, UK, and the Eurozone in general. But near term, if the impact looks minor, and it does look like they're muddling through, even though we think the euro continues down, but more slowly in this case, after maybe a little bounce, the pound may be a surprise, one that is pretty much hated at the moment. We said at the beginning of the year that we expected a double-dip global recession in the economy, and part of it was because of the systemic impact we expected from Europe. And if we get that, if we get a double-dip global recession, the currencies that get hit the hardest, of course, are going to be the commodity currencies that have been flying on growth. Aussie, Canadian dollar, New Zealand, Brazilian real will get it very, very hard if this Eurozone austerity or breakdown in the system leads to a double-dip recession. European breakup and contagion. We talked about the impact on the Eastern Central Europe. Obviously, the euro gets killed in a big way faster. Swedish krona, we think, is a good currency to play short on any signs of contagion to Eastern Europe. We think it'll get hit very, very hard. It's another one to play outside of the euro, and we think Swiss franc could be in trouble. It seems to be trading with the euro, has been a little bit stronger. On a relative basis, we'd have to say if we had to pick between the three, we definitely would take the Swiss franc among those three in the contagion problem. But the contagion problem may lead to some banking upset in Switzerland that I don't think the market has absorbed yet, and that's why we have the Swiss franc in there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.